If you buy gold or silver at any time in January 2026, I need you to watch this whole video, because what happened on the 30th was not just a market correction, it was the destruction of trillions of dollars of wealth that completely caught millions of investors by surprise. Most people still don't know why this happened, or what mistakes they made to turn a legitimate bull market into a personal financial disaster. Gold fell 12% in a single day. Silver fell 31%. The money disappeared within hours. That is why most financial commentators don't get this right. The structural fundamentals driving the entire bull market have never really changed. The central bank is still buying. Supply deficits remain. De-dollarization is still happening. So why have trillions of dollars evaporated? Because of one mistake. A single decision-making model separates people who make money from those who are completely bankrupt. My name is in the past 15 years. I have seen thousands of investors invest in precious metals. Some have become wealthier than they think. The other concerns sold off at an absolute bottom, with metal prices doubling over the next 6 months. Which group made a bigger mistake? Please be consistent with me through this video, because something goes wrong and you learn nothing. But not understanding it can cost you everything. To understand this mistake, we need to go back to the end of 2025, when unusual things began to happen to precious metals. Gold not only rose, but also accelerated sharply. In 2025, gold rose 65%. This is the strongest annual performance since 1979, and we're not talking about niche assets here. Here is CNBC front page news. Your barber asks about gold prices and your neighbor calls gold traders. By the end of the year, gold hit 53 record highs, which means that most investors have never seen such behavior throughout the portfolio lifecycle. Silver is a crazier story. The annual growth rate was 120%. Over the past 13 years, silver has rebounded between the same price levels that traders call ranges. Then suddenly, unprecedented breakthrough resistance. When precious metals broke through the 10-year resistance, serious institutional funds began to ask questions. By the end of January 2026, the real bullish factors had converged. Central banks are accumulating gold at more than twice the historical average. China has been buying gold for 15 consecutive months. India is accumulating. Turkey is using gold to stabilize currency volatility. Russia regards gold as an anti-sanctions reserve. They are not hedging or speculating, but measuring the shift from the dollar to diversification in decades rather than months. The story of silver supply is equally compelling. What we see is demand surpassing production for the 5th consecutive year. Unlike oil, silver can drill another well if prices fluctuate. Silver is mainly a byproduct of mining other metals, which means that supply cannot increase due to rising prices. Solar panels alone consume more than 200 million ounces a year. Add electric cars, semiconductors, 5G infrastructure, and AI data centers that need to cool and explode conductive materials, and math stops working. Supply has not kept pace. On the 28th of January 2026, when gold hit a record high of $5,589 an ounce, the financial news media reported the next round of gains. Analysts at Goldman Sachs, JPMorgan Chase, and Wells Fargo raised their year-end targets. Some called for $6,300 in gold by December. One analyst even proposed a floating scenario in which gold could reach $8,000. Feel it now, because the feeling of missing is so important that if you don't go in now, the boat will leave you. Keep that feeling, because we're going back. On the 30th of January 2026, temporary metal investors were separated from people who really understand how the market works mechanically. If you want to know why President Trump's announcement that Kevin Walsh will be the next Fed chairman will destabilize the entire metals market, here is the answer. Mr. Walsh, who was chairman of the Federal Reserve from 2006 to 2011, is more hawkish than some other candidates. In the market language, hawkish means willing to raise interest rates, and in the precious metals sector, hawkish Federal Reserve policy is poison. Gold and silver don't pay you interest, dividends, or generate cash flow. When interest rates are high, Investors naturally ask themselves why they want to hold a non-yielding asset when treasury bonds are issued at 5%. As soon as the news came out, the dollar soared immediately, and what was important was the mechanical relationship. When the dollar strengthens, the global dollar-denominated gold and silver became more expensive for everyone else in the world. Demand fell and sales pressure increased. This is just a good start. This catalyst alone can lead to a small correction. But what happens next is not just sentiment. It was something more mechanical and dangerous. 99% of retail investors have never heard of such a thing. But institutional investors were keenly aware of this on the 30th of January index rebalancing, which is important because of how money actually flows. Commodity indexes. The Bloomberg Commodities Index and the CEDR GSI operate on mechanical rules. One rule says that no commodity can represent more than 15% of the index. Trillions of dollars in passive funds, pension funds, insurers, robotics consultants, and ETFs automatically track these indexes without making emotional decisions. They play by the rules. By early January 2026, gold and silver had gone too far and exceeded the allowed weight. Gold alone has pushed up 16 or 17% of these indexes, and silver is heavily overloaded. This has led to an automatic sell-off, not because prices are seen as too high or out of fundamental concerns, but because the rules require it. The multi-billion-dollar sell-off is purely an effort to mechanically return weight to compliance. Timing has become crucial, and the sell-off comes at a time when sentiment is already fragile in the Fed's chairman's statement. You see the warm news leading to the strengthening of dollar and interest rate expectations. You see the automatic rebalancing of the index, forcing billions of gold and silver futures to sell, all of which happen at the same time like dominoes, perfectly aligned in orderly decline. But the real disaster comes from a third catalyst: algorithms. Modern financial markets run on algorithms, with thousands of automated trading systems executing thousands of transactions per second. When prices move in one direction, these systems are designed to amplify those movements. Imagine this: gold fell because of the Fed chairman's news and index rebalancing. And while it fell, it broke through the level of technical support. Traders gave stop-loss orders, triggering automatic sell orders when prices fell below a certain point. When the price reaches that level, the stop-loss triggers, and the algorithm sees the sell-off and says to itself, "The market is falling, making me sell more aggressively." This triggers other stop-losses, which triggers more algorithmic selling, which triggers more stop-losses. This is known as a cascade effect, which has become absolutely barbaric in thin liquidity markets and precious metal futures markets. Silver has what traders call structural thinness. This means that the amount of silver actually stored in warehouses and vaults, physical silver, is small compared with the amount of silver that exists on paper as futures contracts and derivatives. It is like playing a musical chair game with 10 chairs but 100 people dancing around. That calculation didn't work on the 30th of January when everyone tried to sit down immediately. Leveraged traders receive margin notices from brokers saying, "Add money to your account now, or we will close our position." A trader betting on 10,000 to control 100,000 worth of silver was suddenly notified to increase his position by 5,000 immediately. Otherwise, your position would be sold at market value. Market prices fell rapidly, so in the worst case they were liquidated and forced to sell. It is reported that silver plunged 31% in a single day and 36% in a single day, the highest level since 1980. But most people miss a crucial part: the underlying reason for holding silver has not changed at all. After that day, I ask myself a simple question: who made the mistake? The answer surprised me because the biggest mistake is not what most people think. The biggest mistake was not buying gold and silver. That is how they bought it. Let me break down 4 different investor profiles I saw that day. Introduction 1. Leveraged players open brokerage accounts for margin trading and buy 100,000 silver futures with their own funds of 15,000. The idea is to simply control a huge position and let the bull market go higher. When silver fell 31% on the 30th of January, its position lost more than 30,000 in value. They received margin calls. Now add another 15,000, Or we LL sell it to you, their agent said. Most of them don't have 15,000 on hand, so their positions are liquidated at the absolute bottom. They turned paper losses into permanent losses. Do you know what happened next? 6 weeks later, silver rebounded 40%. Investors were on the sidelines, and the metal prices they were supposed to hold rebounded. Introduction 2. All-around players take all their portfolios, such as 250,000, of which 100,000 is invested in physical silver bars and coins before the peak. They believe they are actively positioning themselves for lifelong opportunities. The pullback came and their silver position is now worth 69,000, not 100,000. And they panicked because they put all their money in it. Without a plan, they did something emotional, sell and take 69,000 and leave. 6 months later, the same 69,000 was worth 110,000. Intro 3. The unwitting trader bought silver because their friends told them it was rising. They don't know structural deficits or industrial demand curves. They don't understand volatility. All they know is that they have risen 120% and want to go in. When silver plunges, they panic because they don't have a knowledge framework to ask themselves, is this a correction in the bull market trend? Or is the bull market trend really over? They sell at the bottom because they don't have confidence or understanding. Introduction 4. Prepared investors have a plan before buying anything. They decided, I believe in the long-term value of gold and silver, but I know they are unstable, so I position my portfolio at 5 to 10% instead of 40%. I use only physical metals, no margin, no futures. Because if I'm forced to leave in bad times, my broker won't do that. I hold it for many years, and short-term adjustments will not affect my strategy. I diversify into gold, silver, and other assets instead of 100% precious metals. I also understand the story of the central bank's shift from the dollar to diversification, a supply restriction that will take years to work. When silver plunged on the 30th of January, investors did something counterintuitive. They bought more. They understand the difference between falling prices and a fundamental collapse. And they know that falling prices don't mean the paper is wrong. That means opportunity. Investors are sitting on huge returns. So, what is the biggest mistake in 2026? It did not buy precious metals. Precious metals have proved to be a firm decision in 2026. The mistake is making big investment decisions without planning for inevitable volatility. Silver volatility is not new. As everyone who studies the market knows, silver is harder to move in both directions than gold. But investors buy without thinking, how much money can I lose? How long can I stay up late at night? What can I hold? What can I sell? And how much of my portfolio can really be put here? They bought in hope and sold in fear, and they learned the 30,000 lesson, why it didn't work. Let me give you some numbers, because the background is more important than you think. In 2025 alone, the central bank bought 863 tons of gold, more than double the average from 2010 to 2021. These are not retail investors, these are governments and sovereign wealth funds that will not panic and sell off because of a day's price action. 95% of the central banks surveyed said they expected to increase their gold holdings in the next 12 months, and none said they planned to reduce their holdings. JP Morgan Chase expects central banks to buy about 800 tons in 2026. China maintained a 15-month winning streak. Turkey is using gold to stabilize its currency. Russia regards gold as an anti-sanctions reserve. Now compare it to retail behavior on the 30th of January, panic selling, forced liquidation, margin calls. So, who is wrong? The central bank is accumulating or retail investors are selling. Specific to silver, the supply situation is actually tightening, not tightening. Inventories on the Shanghai Gold Exchange, the global market leader, plunged to 10-year lows after record exports. Solar demand alone consumes more than 200 million ounces a year. Industrial demand is accelerating, and it is important that there are no substitutes. Every attempt to replace silver in electronics, solar panels, 5G infrastructure, and other areas has failed or led to poor performance. Structurally, in May 2026, All factors that made gold and silver attractive in January remained unchanged. The only change is the guarantee position and market positioning. The central bank is still accumulating. Supply remains short. Industrial demand is still growing. If you made a mistake in January and millions of people made a mistake, don't blame yourself because that is the tuition for a financial education. But don't make it again. Before investing in precious metals or any volatile assets, write down the answers to the following questions. How much of your portfolio can you make without affecting your sleep? Most experts recommend 5 to 15%, depending on your overall strategy. Not 40%. Not 70%. How long are you willing to hold this? If you can handle a 30% silver or 15% gold correction, you are not ready for the long run. You should buy and sell treasury bonds. What is your plan for volatility? If prices fall, will you sell, stay steady, or buy more? Know this before investing, not after the price hurts you. Are you using margin? If so, your risk profile is completely different. You can't afford the same volatility. Stop losses and the size of positions have become crucial, and to be honest, most retail investors should not use precious metal margin at all. Do you understand why you own this? Can you explain the paper in 2 minutes without referring to a YouTube video? If not, you have no reason to own it. Knowledge is the best hedge against panic. Investors who hold through the 30th of January and actually buy more stocks are not sentimental robots. They understand that short-term price volatility is different from long-term fundamentals. They know the story of central banks and silver supplies. The realization that the day's decline had not changed the decade-long trend that drove metals higher gave them confidence to act when others panicked. I'm not here to tell you that gold and silver are bound to rise because the market doesn't work that way. I am here to tell you that one of the biggest mistakes precious metal investors made in 2026 was not that they chose to invest in metals. It is that they're not prepared ideologically and strategically for the volatility of that choice. If you think precious metals are inflation protection, part of a diversified dollar portfolio, or because you really believe in de-dollarization, you need to make a plan. Not hope. Not FOMO. A plan. That means changing jobs. That means understanding your time frame. This means knowing your exit strategy before entering. That means if you're not a professional trader, substitute physical metals for margin. To be honest, that means doing research before buying, not after. Gold is now 13% cheaper than it was on the 28th of January. Silver is much cheaper. Structural fundamentals, why you want them, have not changed. They have actually strengthened. So if you are looking for an entry point, the 30th of January will give you one. Whether you take advantage of the opportunity or are freaked out, you can tell us everything you need to know about whether you have a plan. Looking ahead, maybe that is the real question. Do I have a plan or just hope? Because in the market, hope is not a strategy. 2026 only proves this in painful and expensive details. If you find this section valuable, I will thank you for your support and subscription. If you've made the mistakes we've discussed, and I'm not here to judge, because most investors have made mistakes, please comment and let's talk about how you rebuilt your precious metal strategy. The metal market has nowhere to go. It is a long game, and as long as you're playing a plan, you're in it. Without it, you're just gambling. Thanks for watching. See you in the next video.